Hello, good evening, everybody, and welcome. Also, welcome to our Facebook audiences. We hope all of you had a wonderful day. Thank you for joining our webinar tonight. So, tonight, our topic is how to invest in multifamily apartment buildings. So, before we start, a few ground rules. If you have questions throughout the presentation, please type it in the chat and we will get to them in the order that it was received at the end. So, stick around for that. So, yeah, let's go ahead and get started. Without further ado, allow me to introduce the man who, despite all of his successful businesses, his biggest satisfaction is helping others succeed as an entrepreneur. He's the man that made all of this possible, Mr. Nhan Lam himself. Yan, can you hear me?
Me. Can you guys hear me?
Yep, loud and clear.
All right, perfect. Well, Vaughn, thank you very much for the wonderful introduction and happy September, September 8th. Tonight's topic is going to be one of my favorite topics, which is how to invest in multifamily apartment buildings. Okay. Now everyone mostly knows how to invest in real estate via fix and flip or wholesaling or buying a simple one unit rental property to be able to hold for long-term wealth. But to be able to purchase multiple units in a building, whether it be 100 units or 200 units or even 10 units, for example, is a huge accomplishment because now you can accomplish more with less effort. All right, you can do it takes the same amount of time to structure the same deal for a multifamily project versus a single unit project. Okay, so as we pull up the presentation here, um, let's go through the basics real quick. Okay. Well, first of all, why do we want to do rentals? All right. Well, guess what? Long-term wealth is the key. Very basic principle is that you have a mortgage. If you buy the property with a mortgage and you have a tenant paying rent, which will give you a positive cash flow, and you use that revenue to pay down your mortgage, principal and interest, while cash flowing at the same time. So overall, you are increasing your wealth over time. All right. Also, our federal government encourages landlords to be landlords, to own rental properties for the purposes of depreciation. All right. The property value depreciates over time, and we can depreciate that value to offset our taxable liabilities. But that doesn't mean that the value of the property went down. It just means you're allowed to depreciate the value of the actual building itself that you own. All right. And of course, you want a cash flow. Cash flow is the lifeblood of your business. Without cash flow, your household will shut down. Okay. So, what are the reasons that you should invest in multifamily? All right. First of all, in multifamily, you're going to have what I call a controlled appreciation through a value add strategy. Now, for those who remember about 10, maybe 15 years ago, during the Great Recession of 2008, prior to that, investors, so-called investors, were counting on buying single-family homes or townhomes so that would they appreciate in 6 months, 12 months, and they could sell it off for a nice profit. All right. Well, guess what? That appreciated because of a real estate bubble. It wasn't controlled, which means you had no control on how much it increased and you had no control how much it deflated. Okay. So the key to a safe and secure investment is being in control of that investment and having a controlled value add plan that you can guarantee will increase in value because of what you're planning to do with the property to improve its value through the business and cash flow. All right. In addition to that, all right, you're going to have more units, which is less risk. Well, if you own only one unit and that tenant vacates, now you have 100% vacancy. But if you have 10 units or 100 units, all right, let's say 100 units, and one of your tenants leave and vacate, guess what? You only lost 1% of your occupancy, which is a lot better than 100% of your occupancy. All right. So the more units you have, the less risk you have in case someone were to leave as a tenant. Also, there are less competition. There's a lot of newbie investors or so-called investors who are looking to buy single unit real estate because that's what most people do. They think they can get a Fannie Mae, Freddie Mac loan, qualify for a mortgage, put a tenant aside, and then they live happily ever after and then do it over again. Little do they know is that these loans that they're getting are not non-recourse loans, and also you can have only a limited amount of loans under your name if you don't structure it properly. All right, so there's a lot of competition for the single family rentals, but there's very little competition for the multifamily marketplace because it's just, it's just a little bit more education and a little bit more analysis involved. So why, ask yourself, why is there less competition in the multifamily marketplace? Well, people don't try because they think there's a lot of competition. All right. And because there's a lot of money involved and they think there's a lot of competition. So that's why they don't get involved. Also, the dollar amount scares small investors. See, if you're used to investing in fix and flip deals or maybe a single unit rental property in the Northern Virginia, DC metropolitan area, you might be accustomed to investing maybe $200,000, $300,000 for a single unit, but you don't think about buying a building that costs millions of dollars to be able to rent out. So the dollar amount scares off a lot of the smaller investors. Also, there's a lack of education. They just don't know what to look for. They don't know how to analyze it, don't know how to raise the capital, and don't know how to do the value add plan with capital expenditures. And also, they may be lacking an efficient and proven system that works, all right, in any business, whether it be fix and flip, wholesaling, multifamily, or even McDonald's, or for that fact. You got to have a proven system that's been repeatable and duplicatable. All right. If it's not repeatable, that means you can't predict your success, and therefore your business is not sustainable. You got to have a proven system that is very repeatable. Okay. So to go through more details about how multifamily business investments work, I have the distinct pleasure of introducing a gentleman who's near and dear to my heart. We've met many years ago, done some deals on his own, and now he's founded a company called VIP. And I'm going to let him share with you what that does with regards to multifamily. So, Mr. Lee Johnson, I'll turn it over to you, sir.
Thank you for having me.
Thank you.
Hello, everyone. How are you doing this evening? Nhan, thank you for sharing your platform with me. And I'm 6'3", probably 6'4", but I consider Nhan to be my big brother because in I think it was 2015 when I returned to Northern Virginia, my wife and I, we wanted to start off in rehabbing properties. And, I saw this guy, he came into the room and he says, "Hey, I'm having this boot camp, and this boot camp is going to be for you. And if you come and you participate and you do a deal, it's basically for free." And I said to myself, wow, you cannot beat a free offer. And from that point, I attended that boot camp, right? And I pulled Nhan over to the side and I told him at that boot camp, I hope you remember this, Nhan. I said to you, hey, I'm going to be a student that does a deal within 30 days. And lo and behold, because of that circle of trust inside of that room, we actually did our first deal in about 11 days. I believe we went under contract probably a day or two after Thanksgiving. And to show how big Nhan's heart is, he actually picked up my call either the day after Thanksgiving, and I was like, "Hey, what's going on? What's the next thing that has to be done?" Because this was my first time. Long story short, because of that circle of trust inside of that room, I was able to complete my first flip deal, and I think we exited that deal probably about 90 days later with about 45 grand into our pocket. Plus, Nhan gave me my refund for that boot camp class. So I love it. And ever since then, I consider him to be my big brother. So I'm always happy to come and, have a conversation with his students on what I have done and where I have transitioned today. So what we're going to talk about is how to invest in multifamily. And multifamily is similar, all of the same tools and tricks that you've learned with either buying single family rentals, either a duplex, etc. Many of the steps that you have to take in order to get there are actually pretty much the same. And we're going to give you two different scenarios tonight. One is if you are an individual investor, how could you do it? Right. But the second way that we're going to show you is how you do it when you're investing along with a group. So a little bit about me. I'm a technology executive, and I love tech. And one of the reasons why I'm invested in real estate is so that I could have that opportunity to free myself from, the rigors of a job. So my goal is to continue to do tech, but anytime I'm ready to walk away, I have that passive income and I'm going to be able to do it. So I'm a technology executive, 20 plus years in the game. I've basically been all around the world having implemented technology solutions. South Africa, spent 2 years there, another 2 years in Singapore, touch Europe and, other parts of Asia. But I've had a really good career, right? And that's the reason why, because when I started to have a family, I was saying to myself, either I could continue to travel like this and basically move all around the world, or I could settle down into something where I was going to get passive income. So what you see at the bottom is my wife and I, when we transitioned out of doing rehabs, we made the transition over to investing in multifamily. And today we are invested in a portfolio that is equal to about 328 million, and it's a little over 2,950 doors at this point in time. We're working on a deal that we're calling our Thanksgiving project. And that Thanksgiving project is probably going to come due in November timeframe. And that's going to be about 460 doors, which is going to add to the portfolio and take us over 3,000 doors assets under management. So I'm going to show you how I did it. These are some big numbers. I'm going to show you my part in his investments. And hopefully by the time we get through this, you will have learned something. You will have a couple of questions, and hopefully we can answer those questions for you. So I always have to put this disclaimer out there is, I'm an investor, right? And what I'm doing is I'm sharing my personal experience with you, right? Your situation may be different, either better or worse. But what I would say, whenever you're going to move into any type of financial situation, right, you want to contact your financial advisor, your attorney, or your accountant to make sure you're setting up the proper structures so that your investment is going to allow you to exit in a whole type of situation. So please consult your financial professional before making any financial decisions. So today, the agenda is going to be with multifamily investing. The first thing that you have to do is you have to select a market. It's called the MSA, right? Now, there are plenty of assets in every single different MSA, right? And MSA, you will see, stands for Metropolitan Statistical Area, right? But you have to determine what is going to be your acquisition criteria, and we'll dig into that just a little bit. You have to do underwriting. You might, underwriting is the same with multifamily as it is for fix and flips or for BRRRR strategies. It's going to be an Excel spreadsheet. The thing with this Excel spreadsheet is that it's several different more tabs. It's a lot more powerful. You can do a number of different things. Once you have underwritten that deal and you decide to move forward, you write something called an LOI, which is a letter of intent, right? And you go under contract, at which point in time you perform your due diligence. During your due diligence, you're going to do all of your inspections, right? Plus secure your financing. And then you take over that asset, transition it over to your property management, and you execute the business plan from that point forward. And typically, you're going to exit these opportunities in 3 to 5 years, right? That's if you're going to be doing it all by yourself, right? But typically, because as you can tell, the deals that we're working on in this space are a lot more than when you're investing in a single family rental. The deal that we're currently working on is the acquisition is going to be about $29.1 million. We're having to raise $13.1 million in capital, of which $3 million is going to be for the business plan that we have to execute. I know those are big numbers. I don't want to give you any fear. I'm going to make those numbers as simple and as sweet as I possibly can, right? So I'll go over what is a multifamily syndication, how you can invest, investing through a self-directed IRA, why use a self-directed IRA, and then we're going to walk you through a scenario when you do invest using your self-directed funds. Now, the first thing that I mentioned to you is you have to select an area, right? And there's all kinds of MSAs all around the United States of America. And it's the same thing if you're going to be investing abroad, right? The first thing that you have to do is select your MSA. And then within that MSA, you're going to have a submarket city that's attractive to you. So we're living in Northern Virginia, right? Washington, D.C. is an MSA, right? Richmond is another MSA. And then there's Norfolk area, which is another MSA, right? So that MSA is going to be where you are able to look at the macro data for what's going on in that particular region, right? So in order to do this, you always want to select an area where there are reasons for you to want to invest in that area. One of the reasons why you would want to invest in that MSA is because the rents are increasing, right? If there's a huge population that's being transitioned, and that's happening from the northern states to the southern states, areas that are very attractive right now are North Carolina, South Carolina, Georgia, Florida, and Texas is really, really, really hot right now. I have several different investments that I'm participating in that are located in Texas, and the area is really, really hot at this moment in time. The second step of that is you have to interpret that data to determine whether or not, if of the several different MSAs that you're going to look over, whether or not that one is the best one for you. When I learned how to do this, the instructor basically told us to select no more than 7 MSAs that you want to do your research on, right? So you rank those 7 markets, and then you have an idea as to where you're going to work. You want to then narrow that down to the top 1 or 2 markets for further investigation, because you're going to need data that's going to help you determine whether or not if you're going to move into this area and if it's attractive to you, because you have to make sure that you're going to be able to receive the returns that are going to be palatable to not only to you for your portfolio, but for your investors that you might bring along with you as well, right? So you do that analysis on the 1 or 2 markets, you create that market summary, and then you move forward. I know that that's a lot of information that I just shared with you. Let's start unpacking that, right? So that we can get more into the weeds of what that actually entails. Right? So you have to identify what is your acquisition criteria, right? So you have 4 different classes of assets, and you have 4 different classes of areas, right? A properties in A areas are the absolute best type of opportunity, and D class properties in D areas are the areas that basically have a lot of work that needs to be done, right? So it goes from A, B, C, and D, right? A's and B's are basically fairly new assets, right? Right? It's a class A property if it was just recently built. The builders usually build that from the ground, and then they transition it over. After it ages for a little bit, it goes down to B. B's go to C's, and C's go to D's. One of the things that you cannot do, really, you can reposition, and when you take a property that's at a lower state and you make it into a higher state for moving, for example, moving from a C to a B, it's called repositioning the asset. You can reposition an asset, but you cannot reposition an area, right? So you can do all you want with the asset, but you cannot reposition the area. When I talk about some of this acquisition criteria, the first thing that I want to mention to you is you have to determine what type of asset do you want to own. Personally, I do not like to own any assets that have flat roofs. Why? I don't like flat roofs because guess what? Rain, whatever, accumulates on top of that roof, and you start to have leaky situations, right? So it's preferred for me in my investment criteria to go with a pitch roof, right? My opportunity that I have is to invest in value add properties, right? And value add properties allow me to come in and basically renovate those units as they turn, right? And then as I renovate those units, typically the budget is going to be between $5,000 and $10,000. As I renovate those units, right, what I'm going to do next is I'm going to raise the rents as that property turns over, right? The desired targets that I'm looking for is 8 to 12% cash on cash return or COC, but I'm also looking for a minimum preferred return. The minimum preferred return is my baseline, and what that does is that always protects the investor, right? So when we get into the group investments, you'll see that a preferred return is one of the key levers that I have in my acquisition criteria, and that's because I protect my investors, right? To get the deals, right, you have to market to the property owners, or you have to work with commercial brokers in that area. Really, probably 80% of the deals that are transacted in most areas are through brokers, but you can have a campaign where you're reaching out directly to apartment owners and you're basically pinching them to see whether or not if they want to sell that asset, right, without having to go through a broker. And you can use a number of different tools such as Reonomy. You can use Prospect Now. There are a number of tools that will actually help you to get access to that owner's information, and you'll be able to contact them either by phone, or you can contact them using, yellow letters and things of that sort. One of the things that is really different between investing in single family, like if you're going to do rehabs, is the bandit signs don't really work when it comes to looking for apartments. Maybe if you were looking for anything that qualifies for a residential mortgage, you might be able to find some there. But typically, when it comes to apartment investing, it's a little bit different in how you're going to find those assets as a whole. But you can try bandit signs. I know colleagues who have tried bandit signs, and bandit signs didn't work in this space. So once you have located an asset, you're going to have to underwrite that deal. And you guys may have seen a gentleman named Michael Blank. When we first started this about 4 years ago, we took the Michael Blank course, and Michael Blank has something called the Syndicated Deal Analyzer. And as you can see, this is a complex Excel spreadsheet that has a number of different ways that you can basically do your due diligence on the property. The first line that you see here is what you receive inside of the marketing package. The marketing package is going to come from the commercial broker, and inside of that marketing package is going to be all of the financials, something that we call a rent roll, and you also need the rent roll and you need the T12. You can get by with using the T3, which is the number of months of rent that have been collected, but you typically want to go out between 12 and 24 months so that you get a full picture of what the cash flow is and what the expenses are for that particular asset. So in this particular scenario, what you're doing here is you're taking the information that you have received from the marketing package and you're putting it into the calculator, right? But as the underwriter, you're performing your own type of research, right? So you have to go out there and get your own data and not trust what the commercial broker has provided to you, because you need to make sure that the numbers make sense, right? In the third column, you're going to project how much it is that you'll be able to increase the net operating income, which is called the NOI in the industry. It's the NOI. And the NOI is what you're trying to do by increasing the rents. And by doing so, you actually, because commercial properties are traded on the amount of income that they are able to generate, right? You're able to increase the value of that asset just by increasing the amount of income that's coming into that asset. So how do you do that? There's two things that you can do. On the top line, the first thing that you can do is you can increase the rents, right? But you also can reduce the expenses, which leads to an increase in the NOI. And you can also add amenities to that property, such as, in the unit washers and dryers. You can do reserve parking. There's a number of different things that you can do to actually bring additional income into the property, right? But this is just a highlight of some of those variables that you're going to have to click in order to be able to make this property work for you. One of the things with the micro blank analyzer, syndicated deal analyzer, that I like the most is that similar to what Nhan has with his rehab calculator, it goes from it goes from red to yellow to green. And when you're in the green zone, that means that the numbers have started to work out in your favor. But some of the things that you're going to want to know is that you have to know the rule of thumb expenses for that market, right? Is it really high on taxes and things of that sort? What is the debt service coverage ratio? Basically, how much income is available, right, after all of the expenses have been paid? That is the debt service coverage ratio. You also have the break-even occupancy, and you basically want to perform a sensitivity analysis on the asset to say, well, what happens if this property were to fall to a occupancy of 65%? Will we still be able to cover the debt service, right? And then we have here your cash flow, which is the income minus the expenses, minus the replacement reserve, minus the debt service. So all of that is in there. This is a great calculator. It does help you get into the game, but there are also many other calculators that are out there as well, because sometimes you have to do a waterfall model, right? You have different IRR hurdles and things of that sort. But if you're investing all on your own, you don't really have to worry about investors. So really, this Michael Blank syndicated deal analyzer would work very well if you are, investing by yourself. You have capital that you want to invest, and you're going to go and acquire your own multifamily asset. And multifamily, guys, is anything from 2 units all the way up to the biggest ones that are there. But the difference here is going to be that if you are between 1 and 4 units, you still can qualify for residential mortgage, right? Once you go 5 units and above, you have to qualify for a commercial mortgage, right? And there's different rules and parameters that go into there. You just have to work with a financial professional who understands the different types of financing structures that are there in order to be able to get the best rates and best terms on those mortgages. Now, the second piece of this is after you have completed your not your due diligence, but you have done your underwriting, right? And you believe that this is an asset that works with your expertise, because it's going to be your business plan. Basically, with the value added opportunity here, you're basically doing 1 flip times the number of units that are in the property, right? And you're basically going to be doing flooring, right? You typically come in there with a vinyl plank. You're going to update the cabinets and the refrigerator. As I mentioned, a thing that you can do to increase the NOI is adding in the washer and dryer into the unit. I've even heard people of having trash valet, where you just put your trash can outside in the hallway and someone will come and pick it up for you for a certain amount of money per month. But once you have gone through and you have submitted your LOI, you have to submit your LOI, which is your letter of intent, with an earnest money deposit, right? The earnest money deposit basically lets the broker and the seller know that you are pretty serious about moving forward with that purchase. However, your money has not gone hard until the due diligence period has expired. Meaning, if while you're conducting your due diligence, you find additional items, deferred maintenance is what it's called, that haven't been looked after, you can renegotiate with the seller, right, for things that they didn't disclose inside of their marketing package, right, on items that weren't picked up, and when you did your initial analysis, you didn't see were there. But you still have the opportunity to walk away from the deal should it not pencil out, or the expenses and things of that sort aren't what you were looking for. But one of the things that you have to do when you're doing your due diligence is you have to have a property condition assessment, right? You've already probably completed your market survey, but you want to make sure that you know everything about what's going on in that particular market. You want to visit with the Chamber of Commerce. You want to visit with the Office of Economic Development. You want to understand what's going to happen in that particular area for the next 5 to 10 years, right? Because that's when you're typically going to want to hold this asset and eventually execute your business plan. And at that point, either you're going to sell it off or return capital to your investors. But there's many different options that you have from an exit strategy. You're going to do a financial document audit, right? You're going to do a lease audit where you look at the tenants to make sure that those tenants have the incomes and the profile to make sure that with the renovations that you're going to be doing, that they will be able to afford the rents. Now, this is something that is critical, but the first time that I walked the property, I didn't know that if you have a 300 unit complex that you're looking at, you have to walk every single unit. Typically, you'll have a group, you'll split it up just a little bit, but this is an all-day affair, and you're going to walk at least 50 different units, and you're going to do an inspection report with your property manager to make sure that the budget that you guys have put together is going to be tight, right? You have a site survey. The bank is going to want to have an environmental site assessment, an appraisal, and also a green report on the asset, etc. Many of these things are mandated by the bank in order to secure financing, but you also want to make sure that you know what it is that you're getting yourself into, and you have an idea of the asset that you're purchasing, and can make sure that your business plan is going to be able to be successfully exited, right? However you look to exit the asset. Moving forward, you have to understand that you have to put together the financing for the deal. And in this particular industry, it's called the capital stack, right? And with the capital stack, there's going to be some level of debt that you're putting on the asset, similar to if you were purchasing single family homes, right? So you have your capital stack. The one difference when you're working inside of the multifamily space is you can sell off pieces of the equity, right? So you can have different types of equity, different classes of equity. Many of the deals that I have been involved in have either Class A or Class B, and each of those classes have different types of return. For instance, something that I've seen of late is that offerings are being offered whereby you don't get any upside in the equity. You're just going to receive an interest rate that they're going to return money to you. For instance, what I've seen is that you'll have a 9% interest rate on your money, but typically the minimum investment is going to be at $100,000, right? Or an example of a second example is that there would be a Class B structure inside of the capital stack, and that Class B is probably going to receive a 7% preferred return, but they will be able to participate in the upside when the property is sold, right? So typical to if you're investing in single family, right, you're going to have a down payment. The down payment when you're doing multifamily is going to be typically between 25 and 30%, right? And in order to secure this deal, you're going to need somebody called a key principal. And your key principal is going to be the person who signs off on the loan. It could be one individual. It could be up to, 3 individuals I have seen. And the loan signer, right, has to have a net worth equal to the mortgage of the property plus 10%, right? So that individual is going to be pretty wealthy. So you need to know someone who's wealthy, but there are a number of people who, if you don't have that person inside of your Rolodex, there's different ways that you can find a key principal in order to be able to sponsor your deal if your net worth doesn't equal that. Right. So when you're looking at a typical deal, right, we started looking at an asset that was in Arlington, Virginia. And it was 14 units, and it was a Class C value add opportunity. As I mentioned earlier, there are Class A's, which are, opportunistic opportunities, usually very young assets built in 2020, 2019, 2020. Right, then there's Class B, a little bit of an older asset, but not much different maintenance. And then there's going to be a Class C, and you could have Class C plus, you could have Class C, and you could have, sometimes we call them Class C minus, right? And you could have different levels at all of the scales. But this investment was going to require a 30% down payment, which would have equated to 1.35 million, right? The earnest money deposit that you were going to have if your LOI was accepted is $45,000. And that's just called sometimes risk capital, right? With that, you would have put a mortgage on the asset at 3.15 million. You would have budgeted for repairs of about $800,000, and you would have had about just under $109,000 for closing costs. The total investment from the investor would have been $5.4 million, right? Now, everyone knows that, most people don't have $5.4 million sitting on the side, right? So what you would do is you would take on investors. And when you take on investors, then you are playing in the realm of private placements. And private placements require you to have an SEC attorney who's going to create you a document called the PPM, which stands for Private Placement Memorandum. And there's different ways that you could actually bring on investors, right? That could be there's a number of different ones, but the 2 most common that I have seen is a 506, 506B, and a 506C. And there's a little bit of a difference between the 506B and the 506C. And I'll explain that to you in just a bit, right? But that's going to be the story that you have to have if you are a high net worth individual and you're going to go in all alone and you're going to purchase you a small multifamily asset. And basically the reason why you are doing this is most of the time you are looking for some tax deductions. And if you haven't read a book called Tax-Free Wealth by a gentleman named Tom Wheelwright, you will have to speak to your tax advisor or your tax strategist, because you're going to put together a plan on how it is that you can make the most benefit of using the tax code to reduce whatever your tax obligation is, and using real estate as that vehicle in order to reduce your taxes, right? So that's how you get there. And typically, if you have the cash to be able to close on an asset all by yourself, I say hats off to you. It's a great strategy. The tax code is actually written for investors to basically do one of 2 things: create jobs, right, or to create housing. The tax code is written for that. There's all kinds of language that are in there to actually help you to be successful there. But a lot of people don't have $5.4 million laying around. So they have to get creative, and they create something called a group investment, right? And a group investment basically is what I call a multifamily syndication, right? And there are 2 sides to the multifamily syndication. There are the GPs or general partners, and there are the LPs or the limited partners, right? So the GPs are responsible for finding the deal, finding the asset that you're looking to purchase. They're responsible for putting up or sourcing the risk capital that they're going to use for their earnest money deposit. They're responsible for securing the financing, right? They're responsible for conducting and completing all of those due diligence items that we spoke to several slides back. And they will be responsible for managing the property and executing the business plan and actively involved in providing what could be considered the sweat equity that is there, right? So in order to make that happen, right, they need a pool of limited partners or passive investors who basically have a grand bargain. The grand bargain that the limited partners have with the GP is that they're going to make an investment into the business plan or into the asset, right? And for that, they are expecting a return on their money, right? And I do have a structure that I'm going to share with you that displays, well, what is that type of return that the investor is going to be looking for the commitment of their money into that investment, right? But now, in order to make that investment, you have to have the funds, right? And typically for the deals that I have been around, you have an investment of $50,000, right? And you can invest that money either from personal funds or previously you can have stranded 401ks. In this day and age, we are amongst people who haven't worked at a job for 30, 40, 50 years, right? But I will explain to you how if you've had a job or 2 jobs or 3 jobs that you left behind, you could actually bring those 401k monies together and make an investment into a syndication. And syndications are all over. There's syndications for self-storage. There's syndications for brand new developments that are going to be opportunistic. There's core and there's core plus, and value add is the place where I play. Now, there are 2 types of investors that you typically see who are going to be coming into these investments. And one is the sophisticated investor, right? The other is an accredited investor. Let's start off with a definition for what is an accredited investor. An accredited investor has annual income of $200,000 for the last 2 years, or the individual has a net worth of $1 million, not inclusive of their primary residence. The only exception for that is when you have a married couple, and that married couple can have an annual income of $300,000 for the last 2 years, or they have a net worth of $1 million, not inclusive of their primary residence, right? So those are the clear measures in the benchmark, and depending on the type of investment that is there, either a 506B or a 506C. If it's a 506C, which means that you have to verify the investors that are coming in, but the difference between the 506B is that it's only amongst private individuals, right? When you're working with a 506C, you can sometimes see those advertised on Facebook and other social media platforms or the internet in general. And sometimes you could even hear about it when you're in the car and you're driving and there's a radio conversation about, do you want to invest in, cash flowing, income producing assets? And I've heard several that are offering sometimes up to 10% preferred returns. So you have to always do your due diligence on the operator to make sure that they have a track record of doing this. But just in case, if you do not qualify for what is there as an accredited investor, right? If the deal is a 506B deal, right, they are allowed to bring in non-accredited or sophisticated investors up until a certain limit, and that number is usually 34 to 35, right? And with the sophisticated investors, at the discretion of the general partnership, they can either let you come in at the minimum amount, or they can make certain exceptions to bring in at a lower amount. But that's on a case-by-case basis, and it has to be called out inside of the private placement memorandum, whether or not if they have opened up the opportunity to sophisticated investors, right? But sophisticated investors cannot participate in a 506C because the income has to be verified by the operator in order to participate in the deal. I hope that makes sense to you all. Right? So not everyone has 50 grand lying around, right? But I can tell you for sure, because I know this from personal experience, is that if you do have resources that are inside of a traditional banking account or a traditional money market account, you're basically losing the purchasing power of your asset, which is your money, right? Because inflation at this point is pegged at about 2%, and that's where the Federal Reserve is actually happy and comfortable for inflation to be. So if you have money sitting inside of a standard saving account or a standard checking account, you're probably going to be earning less than 1% interest on that money, right? So you're losing the purchasing power because inflation erodes your purchasing power, right? But if you have those funds outside, right, you could always invest them in many different investment vehicles, right? However, if you have stranded 401ks from past employers, you can't do this with your current employer. The law doesn't allow for you to invest monies with your current employer. I could be wrong, and there could be an exception, but I haven't found one where you can use monies from your current employer, right? But those past 401ks, you can actually transition those monies into something called a self-directed IRA. There are other investment vehicles that you could use, such as a solo 401k or a QRP. There are a number of different vehicles that you can use based on your different situation, right? This is going to be on a case-by-case basis based upon your particular situation. But there's a nice little neat wrinkle about all of this, and that is once you have moved those funds into a self-directed IRA, you can invest in real estate, right, directly, or public and private. Private is what I had talked about with the syndication. You can invest in commodities, right? You can invest in precious metals, gold, silver. You can even invest in Bitcoin if you wanted to, right? You can invest in private loans, and many have probably heard that you could also invest in tax liens, right? The thing about when you're in control, because basically that's what the SDIRA does, is it gives you control of your investment, your fate. You are actually at that point in the driver's seat, right? There are specific rules because this is retirement money that you have to follow, right? And you're prohibited from making certain types of prohibited transactions, right? You cannot invest with any family members above you. That's your mother, your father. You can't invest with anyone below you. That's your children, etc. But you can invest with your third cousin and people to the side and other people that you may know. You just have to be very careful about what you do because you don't want to pierce the veil of this entity and get yourself into trouble going down the road. So I hope that makes a little bit of sense. I know I've been speaking and I'm going to get me a swig of water. Are there any questions at this point in time? All right, no questions. Let's keep it moving. All right. So how do you set up your self-directed IRA, right? As I mentioned, right, you can have moved those monies over to other traditional brokerage houses. So you have other IRAs. You're taking that 401k money after you've left your company and you move that over there, right? Now you've left your employer. You have that 401k money that's sitting with the custodian for the company. You can take those monies and you can move it into something, excuse me, called a self-directed IRA, right? And the self-directed IRA, there's a number of different ways that you can do this. There are different types of custodians. The custodian that I use is a company called Madison Trust, and there's another company called Broad Financial that set up my entities for me. But there's UDirect that's out there. There's Intrust is another one. Equity Trust is another one that are out there. What I'm going to explain to you is something called a self-directed LL. It's called the IRA LLC. And what that does is it allows you to create either an LLC in your state, or it allows you to create a trust. And that could be the investment vehicle from which you would make your investments, right? So I have an LLC that was created for me. The company sent me a binder. Inside of that binder was my operating agreement. They also had my EIN number, and it was chock full of information that I could use as to what were prohibited transactions. There's also going to be something called UD, unrelated debt finance income, right? And then there's also something called unrelated business tax income, UBTI. And basically what these are is it's a way to make the landscape competitive for people who are using tax money versus pre-tax money. It levels the playing field, but overall, as you're coming up with your investment plan, it's one of the ways that you can make a difference there. Once you have set up that self-directed IRA, right, you can then go, as I mentioned before, there's a number of different assets that you can make an investment in, and that could be real estate. You can do private loans and doing hard money lending, or as I mentioned before, you can also invest in other assets. And if you are used to or wanting to ride on a roller coaster, Bitcoin is out there for you just the same. I think Bitcoin was down 5,000 points, $5,000 this morning when I looked at it. Earlier, I have a small portion of my portfolio in Bitcoin, but it's really for those people who want to ride on a roller coaster. So that's for sure. But you can invest in a number of different things, right? And what I typically talk about is, and you might have heard the theme that I had overall, is that you want to be in control of your future. You want to take control from the mutual fund companies, from whomever, and you want to be in control of that investment for your retirement. And one of the things where people talk about is that there's a lot of risk. There's a lot of risk in doing this. I also say that there's a tremendous amount of risk if you're going to be invested in the mutual fund. And one of the things that I like to share with them is the fact that there are a tremendous amount or number of fees that are going to erode your investment capital and your principal, right? And basically, this is a long-term game. Real estate investing is a long-term game. You're typically not going to be rich overnight, right? But you want to be able to take advantage of those compounding effects that are there. And these fees erode your ability to grow your capital. So there's usually a redemption fee, there's an exchange fee, there's an account fee, there's a purchase fee. Sometimes there could be a load or no load on basically moving into the mutual fund. There are a number of different fees that if you aren't looking at the prospectus, you probably don't even know that those fees are there. And just continuing on, there's management fees, there's distribution and service fees, or 12B1 fees that are there. There's other expenses. And at the end of the day, basically, you've paid for T. Rowe Price or Vanguard or Fidelity to basically support those fund managers and do all of that advertising that you see at the airport, etc., when you're traveling. right? The reason why I wanted to share that with you is because that erodes your growth potential for your money, right? And here what you see is a small analysis and demonstration that if you invested $100,000 over 20 years, right? What is going to be the amount of capital that you have at the end of 20 years if you have a 4% annual return, right? A 4% annual return, but the erosion of that is going to be different based upon the collection of those annual fees. And these fees aren't enormous, but over time, right? Over time, they have an erosive effect on your wealth, right? So if you see here, the first one is if you have a 0.25% annual fee, and that's typically only going to be available to you if you're invested in index mutual funds. But even if you have a 1% annual fee, the difference between that is 210,000 versus 180,000 over 20 years. And this is, with a very conservative annual return that's there at 4%, right? That's big money, $30,000 that eventually is not able to grow for you because you paid that money in fees. That's one of the reasons why I'm very bullish on using a self-directed IRA. I'm going to bet on myself, and I'm going to bet on my ability to make these types of investment decisions, and that's why we move forward there. So hopefully I was able to give you an idea of how that works, right? And what I wanted to do is also give you an idea of how a syndication actually works, right? And this is going to be the same way whether or not if you're investing with retirement funds, so pre-tax, and it's going to be the same whether or not if you're investing in post-tax. As I remember, I mentioned to you what we're looking for as one of our investment criteria is a preferred return. And what I am showing you is an actual deal. It's the last deal that we did. We closed on this opportunity in July. It's in Galveston City, Texas. It's a 132 unit apartment complex that we purchased, and the name of it was Savon Villas, and we since renamed it to Addison Oaks. On that property, we are offering a 7.5% preferred return, and that preferred return is going to be paid quarterly. You may have remember on my opening slide, I mentioned that the preferred return is there and it protects the investor, right? And of course, if you're going in solo, you don't have any investors, so you get to keep all of the cash. The windfall is yours. However, if you are putting together a syndication, right, the investors on the LP side of the house, they need to be looked after and they need to get paid first because the deal doesn't happen without them, right? The next one that you're going to be looking out for is your annual IRR, right? And that the minimum that we have for that is going to be at 18%, right? And the difference between your cash on cash is an annual, and you also have your IRR that can stretch out over several years, and that's typically how you're going to judge a multifamily investment. Now, I can tell you there are multifamily syndications that are exiting in the high 20%, and so the IRR is tremendous if the general partner is able to execute that business plan superior for you and make sure that you are receiving what you need to receive as a whole. So here, the cash flow distributions that are going to be paid quarterly are paid on an annual basis. You start to see what those are, right? Typically, what you're going to see is in year 3, right? Because in years 1 and 2, you're executing your business plan where you're renovating the units as they turn, right? If they're already vacant, you can renovate them and then put those units on the market, right? Typically, or in most instances, you're going to see that in year 3, there's going to be some type of capital event, right? And at a capital event, the capital event could be a refinance because depending upon how you moved into this deal, right, you either could or you could not get, agency financing. Agency financing is all going to be, Fannie Mae, Freddie Mac, Ginnie Mae, all of those. But what I've seen of late is that people are using insurance, right? Insurance companies to do their investments just the same. But in year 3, there's going to be a capital event where there's additional capital that is going to be returned to the investors. Something that is going to be critical here, and it's just a small minor term, but there's return on capital and there's return of capital, right? One of my investment criteria is return on capital, right? Because that means that if the general partner is returning capital back to you, it's not eroding your original investment criteria, right? If you have return of capital, as this capital is being returned to you, it's reducing the amount of money that you have invested in the deal, right? And I don't believe that that's very beneficial for the limited partner, right? But the cash flows that are going to be returned to you on this investment, right, are $47,000, right? Then at the return of the sale, you're going to get another $63,000, right? So you're looking at here, you're going to be having 110.82% return, cash on cash return on your money once they exit the investment and sell the asset. There are certain other people that tend to hold on to these assets for 7 or 10 years. I haven't participated in any of those because you move that money over. One of the things that we talked about is even with if you're doing a syndication or you're doing a solo investment, there are 2 tremendous capabilities that you have. The first one is you have depreciation, right? And there's depreciation where you can do cost of segregation, right? That basically says that you have a depreciation schedule for every single asset that's in that building, right? Refrigerators, stoves, all of those. And you can put those onto an accelerated depreciation schedule, which means that in years 1 and 2, although you have received cash flows, right, you're actually going to receive a K1 that shows a negative amount. As you would realize, in America, there's no such thing as a free lunch. There's something called depreciation recapture, right, that is going to be there when you sell the asset. But there are creative things that you can do in order to minimize what your tax obligation is going to be at that point in time, right? So this is an idea of a real deal, right? All of this stuff is called a pro forma, right? This is why when you're doing your due diligence, even as a passive investor, you have to understand, well, what are their projections, right? Is that market that they're looking at, does it have the right type of tenants moving? Are there jobs being created? You really don't want to go and invest in the area where the population is shrinking. You always want to go to areas where the population is increasing. And also you want to see that the demand, the rental rates that are already in that MSA are already trending higher. Those are some of the bare bones criteria that you should have for any opportunity that you're looking to invest in. And as I mentioned, one of the great pieces of investing in these types of syndications is the fact that you aren't limited to where you are. As I mentioned, I'm in the Northern Virginia area, and all of my investments at this point in time are in other areas, in particular in the southeast portion of the United States. And if you are able to go to our website and see our entire portfolio. Right now, we're up to 20 syndications, and we're working on our 21st syndication at this point in time, right? And that's going to be the Thanksgiving project. That's 460 doors. So if you wanted to participate in something like that, all you have to do is give me a call. We have a conversation, we establish a relationship, and then we're able to talk about that a little bit more. So let's summarize this up and tell you what you need to do. Whether you have to determine whether or not if you're going to invest solo or as part of a group. The tax benefits, whether or not if you're investing solo or if you're investing as a part of the group, are always going to be there, right? You have to, of course, speak with your tax strategist or your accountant to better be able to understand how you can best leverage those deductions so that it makes you whole as a whole, right? Always do your research before investing, right? You have to understand that MSA. You have to understand that sub market where you're going to be investing in, right? If you're going to be investing in multifamily, you want to basically try to work in states that are going to be more landlord friendly versus tenant friendly, right? You want to be able, because you want to be able to evict a tenant and not have it take months or years in order to evict that tenant, because this is your business, right? Investing in multifamily is your business, right? And it's equivalent to having a tenant in a unit that's not paying is to someone stealing from your store, right? You are here. This is a business. You have to treat it as a business, and you need to make sure that your economic vacancies are as low as possible. So with that, I'll close it out and want to say to you, hopefully this was educational. Hopefully this was informative. But lastly, I want to say to you, happy investing, right? And if you ever have any questions about how I did this or what I'm doing, as I mentioned to you 6 years ago when I returned back to the States, I attended Jan boot camp class, and this is how I got to where I am today. So, Jan, are we going to open it up for questions?
The questions, and first of all, Lee, you guys, I mean, this is a wealth of information, and some of you guys may have just looked at it, and if you're brand new to this, you may have some questions. If you guys are familiar with it, you may still have some questions, and that's why we're here tonight, to be able to help you guys move forward in the platform of multifamily. So let's go ahead and go to the questions here. We have looks like Mr. KG uh, has a question that says, "Who funds these deals?"
Well, if you're going in solo, right, it's going to be you who's funding the deals, right? If you can invest with family and friends, and you can do something called the tenants in common, right? That's an easy structure that you can set up where you don't have to involve a SEC attorney, right? If you're going to solicit investments from third parties and people who you don't know, right? LPs, as I mentioned in my slide, you're going to have to put together something called a private placement memorandum, right? And basically, a private placement memorandum is between an 80 to 125-page document that basically tells the investor of all of the risk and the liquidity of the investment, right? But also you see sources and uses inside of those documents just the same. So one of the things that I had mentioned is that when you're doing a group investment or a syndication, right, you're looking for preferred returns because it's the LPs who are basically putting the deal funding the deal, right? So those guys are going to fund the deal. And one of the other investment criteria that we look for with our operators that we're working with is that they are also investing on the LP side as well as all of the others. So that gives them incentive to make sure that the business plan executes, right? Just the same. So it's a contribution of mainly the LPs, but you typically want the GP to invest in the deal as well.
Awesome. All right. Any other questions? Any other questions? All right. Well, I have a question for Lee here. Lee, let me ask you this: what's your, through your journey with multifamily investing, what's been your biggest satisfaction in this arena, in this facet of real estate over others?
Well, the difference for me investing right now is something that I call mailbox money, right? And of course, you're not really looking for a check to come into the mail, but there are a number of investors who just don't like ACHs for that matter. But one of the things that I like most about this is that I'm not a traditional landlord, right? So I'm not receiving calls in the middle of the night, and I'm not having to deal with tenant situations, right? I don't have to deal with evictions and things of that sort. One of the most beneficial pieces to this is the fact that every month or every quarter, I'm receiving a cash flow distribution check uh, on time, right? And the next piece of this is the fact that I was concerned, right, when we left 2019 and went into 2020, that COVID was going to have an impact on the investments. But, long story short, I started doing this in 2018, and here we are moving into 2020. Just about every single investment has always paid all the time, right? There hasn't been any disruptions in the cash flow distribution. I'll give you a story, if you might. Is when I first started investing in this, I didn't know what I was doing, so I started out with a platform called Realty Shares, right? Because I didn't know any operators, so I invested on Realty Shares. I had 3 investments for about $50,000 that I put into Realty Shares. 2 of those assets, like in 2019, they stopped performing, right? So from 2019 all the way to just now, right? One of those assets didn't pay the cash flow distribution. But I learned on Realty Shares just the same. That property was purchased for $21 million in 2018. It just sold last month for north of $28 million. And all of those cash flows that they didn't pay, right, were basically brought back to me and made whole as they exited the property. So that was the worst performing asset that I had. And even with that worst performing asset, right, it still made me whole at the end of the day. I think year over year, when I look at that investment, it was about 12% that we made on the money, which is better than nothing. It's better than if the money had been invested inside of a money market or a checking account.
Awesome. Awesome. And are there any questions on our Facebook audience? Any questions from our Facebook audience? Vaughn, are there any questions from our Facebook audience?
No questions from the Facebook audiences, Yan.
Okay. We have Miss Gina Mills here. Ask a question. If you participate in a syndication, what is the required investment? I'm assuming the minimum required investment. So Lee?
No, there's a number of different investment levels that you can have. As I mentioned, that what I'm seeing a lot now is different classes of investment, and there are certain investments that are in the capital stack, right? Each one is going to be on a case by case basis, and they will have a different minimum investment. So the example that I shared with you is that if you're going to be a class A, right, they're going to give you a 9% preferred return, but they're not going to allow you to participate on the back end, right? So you get that whole 9% interest paid on a monthly or quarterly basis. That could be your class A. But there could also be a class B, right? And that class A minimum investment is, let's say, $100,000, but it could be 50, right? But then you could have the class B that has a lower investment requirement, minimum investment requirement, and that could be $50,000, but it allows you to participate on the back end, right? So whatever appreciation that there is, as I mentioned, this asset was purchased for $21 million and sold for $28 million, right? I was able to participate in that property when it sold for $28 million, and it came back into my account, right? Typically, you will find that the minimum investment for a Class A share in the investment is going to be $50,000, right? And there are some, right? There was one that I invested in. It's actually in Texas. It's called MacArthur Place. And I just received an extra cash flow distribution from that one because the property is performing way better than what the business plan had projected, right? It's actually, they were able to increase the rents by 118% more than what the pro forma had called for. So at the end of each year, when there's a distribution, right, as an investor in that asset, I was able to receive additional monies that time. And that was the only investment that I was able to make in my 4 years of doing this now, where the minimum investment was $25,000.
Okay, great. Well, hopefully that answered Miss Gina Mills' question. Fantastic, and hopefully we'll see you investing in the very near future in the syndication. All right. So with that, let's go ahead and close this off with next month's event real quick. And but next month, guys, is going to be an exciting month. We're going to have our next month's event on Wednesday, October the 13th at 7 p.m. Same location, which is on Click Meeting. You can click on the call to action button, RSVP now, so that way you can register for the event. And the topic is going to be how to be the bank. How are you going to build wealth through private lending? And multifamily, you have always got a little tidbit of it, but multifamily is one way to be the bank. You can invest as a limited partner passively to be able to get returns, but then you can also do things actively as well through other types of investment deals as well. So we're going to go through that in detail next month, and look forward to having you guys there. So with that, thank you very much, Lee. Thank you very much for being our guest speaker tonight and sharing your wealth of information. I know you're very busy, but you spent some time with us tonight and shared all your knowledge and input on multifamily investments. So thank you for that. And ladies and gentlemen, have a great night, and we'll see you everyone next month. God bless.